Is stagflation back? May CPI just surprised everyone. Growth is slowing, inflation is accelerating, and the Fed is frozen, unable to cut rates without making inflation worse, and unable to raise them without cracking an economy that's already losing momentum. On May 12th, the April CPI report landed, and it surprised almost everyone. Headline inflation came in at 3.8% year-over-year. The market was expecting 3.7%. That's not a huge miss on paper, but the monthly acceleration told a different story, and bond markets, rate expectations, and growth stock valuations all moved immediately. The word that nobody wanted to say out loud started showing up in research reports, in analyst notes, and in financial media within hours of the print. Stagflation. Here's what actually happened, why this data print matters more than the headline suggests, what it means for sector positioning, and how the technical picture on the S&P 500 is reacting. Let's get into it. Let's define the term precisely so we're working with the same framework. Stagflation is the combination of stagnant economic growth and elevated inflation simultaneously. The reason it's so damaging and so feared is that it creates an impossible situation for the central bank. The normal response to slowing growth is to cut interest rates. That stimulates borrowing, spending, and investment. But the normal response to high inflation is to raise rates. That cools demand and brings prices down. When you have both at once, the two responses contradict each other. The Fed is stuck. We last saw this on a severe scale in the 1970s, the OPEC oil embargo in 1973, the Iranian Revolution in 1979. Inflation peaked above 14%. Unemployment rose above 9%. The misery index, which is simply inflation plus unemployment, hit double digits. Today, the misery index is 8.1, 3.8% CPI plus 4.3% unemployment. That's not the 1970s. We are not in full-blown stagflation, but the direction of travel is what markets are starting to price, re-accelerating inflation at the same time growth momentum softens. The April 2026 CPI report was released on May 12th. Headline inflation came in at 3.8% year-over-year, beating the 3.7% consensus and jumping sharply from 3.3% in March. That's the fastest annual pace since May 2023. Core CPI, which strips out food and energy, came in at 2.8% year-over-year, also a beat, but the more revealing number was the monthly core acceleration, plus 0.4% for April, double the 0.2% rate from the prior month. What drove it? Three categories. If inflation were the only issue, the Fed would have a playbook. Keep rates elevated, wait it out. But the growth picture is where this gets more complicated. Q1 2026 GDP came in at positive 2.0% annualized. Sounds fine on paper, but that number is distorted by a surge in imports, which subtract from the GDP calculation. Strip out that distortion, and the underlying final demand picture is weaker than the headline suggests. At its April 29th meeting, the Fed held rates at 3.50 to 3.75%, but the vote was 8-4, an unusually high level of internal dissent. Fed Chair Powell rejected the stagflation label outright, stating that is not the situation we are in, but he did acknowledge, publicly, that the Fed's dual mandate goals are in tension. That is the definition of a Fed that is stuck. Inflation too hot to cut. Growth too fragile to hike. JP Morgan Global Research is projecting no rate cuts through year-end. This is where the abstract macro story connects to actual portfolio construction. In a stagflation environment, the beneficiaries are inflation hedges and defensive sectors. Energy, XLE, is the most direct inflation hedge. When energy prices drive CPI higher, energy sector revenues rise with them. Stagflation tends to favor late-cycle assets, and energy is the textbook late-cycle sector. Consumer staples, XLP, performs well when recession risk rises. When growth slows, consumers cut discretionary spending first and maintain essential purchases. Companies with pricing power for everyday goods hold up better. The losers are growth and rate-sensitive sectors. Technology, XLK, faces a double headwind. Rising inflation raises the discount rate used to value future cash flows, which compresses growth stock multiples. At the same time, rate cut hopes have evaporated. There is no longer a pivot trade to ride. On May 12th alone, semiconductor stocks led the selling. Consumer discretionary, XLY, is squeezed from the demand side. When food, energy and shelter costs absorb more of household budgets, non-essential spending gets cut first. Consumer sentiment has already fallen to record lows despite resilient retail data, a divergence worth watching. Two assets outside of equities are central to this story, and both are worth watching alongside any equity positions. The first is crude oil. The energy component was the single largest driver of April's CPI surprise, accounting for more than 40% of the monthly increase. WTI crude has been elevated since early 2026, with the Middle East conflict disrupting supply expectations, the threshold that matters for inflation persistence. If crude holds above the $85 to $90 per barrel range, energy's contribution to CPI will remain substantial. A drop back below $80 would relieve some of the pressure. As of this recording, crude remains elevated and does not show a clear reversal pattern on the weekly chart. The second is the 10-year Treasury yield. When inflation surprises to the upside, bond prices fall and yields climb, as we saw on May 12th. The 10-year yield is the reference rate for mortgage pricing, corporate borrowing, and the discount rate used to value equities. When yields rise on inflation concerns, growth stocks, especially high-multiple technology names, get revalued lower mechanically. The relationship is mathematical, not a matter of opinion. Higher discount rate, lower present value of future earnings. These two assets, oil and the 10-year, are the signal inputs that will tell you how serious this stagflation risk becomes over the next 90 days. Let's look at the S&P 500 chart, because the technicals tell a story that's worth understanding alongside the macro. The index closed at 7,408 on May 15th, up 10% year-to-date. It hit an intraday high of 7,517 on May 14th, but that move failed to hold. The index pulled back and closed below 7,475 the following day. That failed breakout above 7,475 to 7,500 is the first technical signal worth noting. Resistance at that zone is active. On the support side, the chart shows three clearly defined levels. The first support zone is around 7,347. That's where the 200-period exponential moving average on the hourly chart sits, and where buyers have stepped in most recently. Below that, 7,200 is the more significant level, tested and held multiple times in 2026, and now a key reference point on the daily chart. A third level exists near 7,040, where the 50-day moving average on the daily chart would align with prior structure. The broader trend is still bullish. The S&P 500 is above its 50-day, 144-day, and 200-day moving averages. Technical scorecard: 12 buy signals, 0 sell signals on moving average indicators. However, RSI is in overbought territory, which historically raises the probability of short-term consolidation before any continuation. On the Nasdaq, the picture is similar. Bullish trend intact but momentum extended. Technology's 22% YTD gain has been driven largely by the AI semiconductor cycle. The stagflation concern is a valuation headwind, not a chart reversal signal yet. What to watch on the Nasdaq? A sustained close below its 50-day moving average would be the first meaningful technical deterioration. Here's what you can do with this information. As a student of markets, not as investment advice, context and frameworks don't eliminate risk, but they eliminate confusion, and that's where most retail investors lose the most ground. Let's bring it together. The April CPI came in hot, 3.8% year-over-year, a beat on both headline and core, driven by energy, shelter, and services. At the same time, the underlying growth picture is softer than the headline GDP number suggests. The Fed is paralyzed between two contradictory mandates, and the rate cut expectations that drove this year's equity rally have been effectively eliminated for 2026. Stagflation? Not the 1970s version, but the conditions, re-accelerating inflation plus slowing growth, are moving in that direction. The June CPI print and the June FOMC meeting are the two moments that will tell us whether this is a blip or a trend. This video is for educational purposes only and is not investment advice. Always consult a licensed financial professional before making any investment decisions.